Accounts for 2024 and the updated results for Q1 2025. We'll take questions at the end of today's presentations, and can I ask those online to use the chat function or to raise their hands? We have people in the room with us here today as well, so I'll take questions from the floor after the briefing. This morning's slides will be made available along with the publications on the CSO website, cso.ie, and a recording of today's briefing will also be made available on the CSO YouTube channel. Contact details are available in the publication and on the press release, so please contact us at any stage with any queries you may have. So I'll now pass over to my colleagues Kieran and to John to take us through the national accounts and the international accounts. Many thanks, Kieran.
Thanks, Rachel. Morning, everyone. I'll take us through our national the first full results for annual 2024 and our final results for Q1 2025. Starting with the annual. So we see here our main indicators. Our gross domestic product is up 2.6% in the year. Gross national product up 3.3% in the year. Looking at our deglobalised indicators, net national income up 4.5% in the year. Modified GNI or GNI star up 4.8% in the year, and modified domestic demand up 1.8% in the year. In our annual national accounts, we have three views of the results. We can look at GDP by incomes, and looking at that, wages are up 3%. Profits in current prices are up 9% in the year. And in more detail in the wages, we see our couple of the sectors driving that strong result. Industry, the wage bill was up 6%, and public administration up 4% in the year. Looking at GDP by producers, we saw domestic sectors up 4%, and the foreign sectors up 2%. And when we look at some individual sectors, we see manufacturing, obviously the largest of the foreign sector, down 1% in the year, and finance and insurance up 16% in the year. Very strong results driven by really interest margins. Looking then at expenditure, personal expenditure, spending was up 3% in the year, and exports up 9%. In more detail, looking more detailed at spending, we saw clothing and footwear was up 13% in the year, and spending in restaurants and hotels up 5%. So moving through some of the headline results that we show you every quarter, and in brackets there are the previous preliminary annual estimates that we gave you in the sum of the quarter. So GDP is up 2.6%, that's up from 1.2%. This is our first estimate of GNI star at 4.8%. Modified domestic demand is up 1.8%, down from our previous estimate of 2.7%. Personal consumption is up 2.9%, up from 2.3%. Modified investment is down 4.2%, when we had it up at 2.2%. The multinational dominated sectors are up 1.5%, having initially been estimated down nearly 1%, and then the domestic sector is up 3.6%, up 2.1%. Compensation of employees or the wage bill, we haven't made no revisions to that at 2.9%. So the reason for these revisions, it wasn't a benchmark year, so we just had our routine revisions, and we just had that extra detailed information that we get from, for example, the Revenue Commissioners, corporation tax, income tax, and our PMOD data sets, and then our structured business surveys from our colleagues in our business sections in CSO, like the Sense of Industrial Production, the Annual Services Inquiry, and our Prodcom inquiries. We also have annual revisions to 2023 and 2024 data from the CSO's balance and payment surveys. And then since we, in the last year, there's also been an update of the Household Budget Survey 2022-23 published, which we included in our personal expenditure results. Looking at the year-on-year growth rates, I suppose the main story there really is that we continue to have, since 2020, strong domestic results in that, as we can see in that GNI star figure, 4.8% this year. And the GDP, the total economy, has recovered from that decrease in 2023, really driven by the recovery in the multinational sector that we saw over the year. Quantifying, I suppose, those revisions we made, our initial estimate of GDP for 2023 was 510 billion. It's now at 525 billion. And then in 2024, we've increased from 533 billion to 563 billion. If we walk now, looking at our modified GNI star, and we walk from that GDP figure of 563 billion, we can see we take away the net factor flows, the 140 billion profits that leave the country, and leave us a NP of 422 billion. A small adjustment for EU taxes and subsidies give us gross national income of 423 billion, and then we make our adjustments for factor flows for non-redomiciled PLCs, and also depreciation of those globalised related assets such as R&D and aircraft leasing. And we made an adjustment of about 102 billion to leave us with our GNI star figure of 322 billion. Then our net national income figure, if we start again at the 323 billion GNI, we take away all depreciation this time, not just the globalised elements of it, and leaves us with a net NNI figure of 288 billion. I suppose the importance of these different levels is we can see when we look at other indicators of the economy, and then we use them as a denominator. So obviously there's quite a difference there, 30 percentage points between the national debt when measured against GNI star versus GDP. Similarly, the general government balance as a percentage of GDP and GNI star is quite different. And I guess it's important then when measuring expenditure in the economy in any health, education, defence, any other measure to realise which denominator you're using, GDP or GNI star. Looking at those, our suite, I suppose, of deglobalised elements, we can see that in measuring the size of the deglobalised economy, they all tell a pretty similar picture. GNI star, NNI and MDD, but the growth rates can be slightly different, and MDD there in particular, which I suppose includes modified capital formation or investment, so can be impacted by investment decisions by large companies or by government. So, but generally, as a measurement of the size of the deglobalised economy, they all tell a similar picture. And here we see that more detail with the percentages. Are all the three measures are between 51 and 57% of GDP, which is getting back towards the levels it was before 2020, but still a long way off the levels in 2016. And if you go back further, 2014, it was over 80%. The numbers were over 80. So we've obviously seen a large change in the economy over the last 10 years. Where this puts us in Europe, we can see we're in the middle here to the right, above the EU average of about 1%. This again is the looking at the sectors, foreign and domestic. Again, the domestic sectors, four years of growth. The foreign-owned multinational dominated sectors had a weak 2023, but we saw recovery in those sectors over the year in 2024. As I said at the start, we can look at the GDP by three different measures in our annual accounts, and we have a lot more detail involved for people to root through and have a look. So one way, looking at GDP by producers and intermediate consumption and costs against output, divided into intermediate consumption or costs versus gross value added, and we can see in the bottom line for the total economy, it's fairly evenly spread, but for some sectors, construction, information and communication, the costs are a lot larger percentage of the output, and then there's others, real estate activities, public admin, where gross value added is a larger percentage of output. Similarly, we can look at GDP by incomes, and 25% of GVA in 2024 was made up of consumption of fixed capital, and 29% compensation for employees, and 46% net operating surpluses. And I suppose I'd encourage you to have a root through our annual national accounts today to get more detail on these pieces of information. Looking at expenditure then, you can see that the GDP result really is driven by this increase in government expenditure and personal expenditure, but also a large increase in net exports in the year, with a fall in gross fixed capital formation. When we strip out the globalised element and look at MDD, we can see the impact, I suppose, on the modified investment on the MDD figure. So it decreased from 61.8 to 59.1 from 23 into 2024. Looking at a bit more detail on the contribution to modified domestic demand, you can see it's that yellow bar, modified investment, that's bringing down the result in 2024. And then, again, contribution to modified domestic demand and net exports and others to GDP growth. I suppose, again, it's that story we see positive the modified domestic demand, positive domestic growth for the fourth year in a row, and a recovery in the foreign-owned multinational sector from 23 into 24. Looking now more detail at expenditure, and if we look at personal expenditure, again, the result of a 3% increase has us to in the middle there, safely a couple of percentage points above the EU average. Looking at the figures behind this, again, there's more detail on this in our release today. We can see most items increased. There was growth in most spending, growth in spending in most items in PCE, but particularly clothing and footwear, restaurants, hotels and transport, with some falls in education and alcohol and tobacco. Looking at capital formation, the picture's a bit different. We had an overall 29% decrease and a 4% decrease in modified investment. And really, we can see apart from software, all elements are down, but in particular those two elements, transport equipment and research and development, which include those globalised assets, had large decreases in the year. I think there was a large export of IP impacting that research and development number. So the overall annual summary, GDP is up 2.6%, GNP up 3.3%, GNI star up 4.8%, NNI up 4.5%. On the output side, industry down 0.5%, information and communication up 6.2%, construction up 0.8%, distribution, transport, hotels and restaurants up 0.7%, and the finance and insurance activities up 16.1%. The multinational dominated sectors are up 1.5% in the year, and the non-MNE dominated sectors up 3.6%. Expenditure side, PCE up 2.9%, government expenditure up 5.3%, investment down 29%, with modified investment down just over 4%, net exports up 46.8 billion. Final domestic demand then down 8.8%, and modified domestic demand up 1.8%. The net factor outflows fairly flat over the 2 years, of around 134 billion. So looking at price effects, the implied GDP deflator, I suppose an overall indicator of prices across the economy, was up 4.5% in the year, and on the consumption side, the implied deflator up 4%. This compares with our CPI figure of 2.1%, I guess being brought up by the items outside that basket which had higher price levels, like foreign travel and FISM. So quickly running through our updated Q1 final results. I guess we showed you this a month ago. The main thing to point out is we've revised down our GDP figure from 9.7% to 7.4%, still a pretty big number, and we've revised up MDD 2%. It's hard to, a couple of the sectors across the top, we've had small revisions down in industry and information and comms, and then small revisions down to personal consumption, government expenditure, and an increase to imports. So looking at this over time, we can see, again, we've had a number of, we can see that recovery in GDP in starting in across 2024, and consistent domestic growth in MDD across, again, since 23. But looking quickly, I suppose, running through, this is our third estimate of Q1 GDP, and today it's plus 7.4%. And I suppose why we made such a revision? Well, the main reason is the latest data includes that detailed annual information we have and the updates to the base periods, and obviously any change to 2024 might have an impact on Q4 24, which will have an impact on our quarter-on-quarter growth into Q1. We also have a new base year for constant price data, and as well as changing the base year, we also update any of those price series, including incorporating the WPI, the full rebased, revised WPI series. And then we've an annual review of seasonal adjustment, and obviously any change in the seasonality in previous years will have an impact on the adjustment that we make in Q1. Still, as I say, still a very large number, and puts us at the far right of this chart, an outlier if we look across Europe. So, yeah, I think it speaks for itself. So the quarterly summary, GDP up 7.4%. On the output side, industries up 16.5%, information and communication up 0.5%, construction up 7.9%, and distribution, transport, hotels and restaurants up 0.8%. The multinational dominated sectors are up 13.6%, with the non-multinational dominated sectors flat. On the expenditure side, PC is up 0.3%, government expenditure down 1.3%, investment up 70%, with modified investment up 10%. I suppose that's the figure that's really driving that NBD growth in the quarter. As I said, the investment decisions do have an impact on on MDD. Net exports down 0.2%, so that's down around 107 million. Final domestic demand up 22.3% and modified domestic demand up 2%. The net factor outflows 17.6 million, in a 7 billion increase from quarter 4 2024, and GNP down 7.2% and COE down 1.3%, seasonally adjusted in constant prices in the quarter. So thanks. I'll pass you on to John now for the international accounts.
Thanks, Kieran. So now I'd like to take through the international accounts. We're looking at our data revisions across the 9 quarters from Q1 23 to Q1 25. Our updated annual series, like the redomiciled PLC's data for 24, CA Star data for 24, and the US current account for 24. Now, I know we started producing this quarterly, and we will certainly continue doing that, but we have a new edition this time, so I thought it worth mentioning. So first, I suppose your question is going to be what's changed since the preliminary release, and the answer is very little. Our merchandise surplus is unchanged at 74.2 billion. Our services balance of minus 375 million is up just 35 from the previous figure, and our net income outflows of 68 billion are down just 784 from the previous figure. So these all combined to give us a current account balance of 5.8 billion, which is down 750 million on the previous figures. So looking at the revisions across the 9 quarters, looking first at the net merchandise, we can see that there's very little change from our previously published figures. So for the whole of 23, there's an increase of just 628 million, bringing us to a surplus of 156.7 billion. And a 24 decrease of just 1.1 billion, giving us a surplus of 175.6 billion. Looking at our services, we have some bigger revisions here, but still not huge. In 23, we have an increase of 6.9 billion in the overall balance, bringing us to plus 18.6 billion. And in 24, an increase of 11.2 billion, bringing us to 59.7 billion in the revised figures. Looking at our income balance, we see our new figure for 2023 is net income outflows of 138.4 billion, up 11.8 billion on our previous figures. And in 24, 144.3 billion, up 10.7 billion on the previous figures. And these three combined give us our overall change to the current account balance. So for 23, our new current account balance figure is 36.9 billion, down 4.3 billion on the previous figure. And in 24, it's 91.0 billion, down just 0.6 billion on the previous figure. One of the chapters that we produce annually is our redomiciled PLCs chapter. So redomiciled PLCs are companies that have moved their head offices to Ireland in what can also be known as a corporate inversion. The inflows of income for these companies have an impact on our net factor flows, and so we show these separately for analysis. We can see here the level of redomiciled PLC income and also their impact on the overall net factor flows. There has been some volatility in the last few years, with an increase from 20 to 21, a decrease into 22, and then an increase into 23. But we've maintained a stable figure of over 10 billion going from 23 into 24. Another important element of these is their impact on our direct investment abroad. So we can see in 2024, the overall FDI attributable to these redomiciled PLC figures is 661 billion, which is up 57 billion from the 2023 figure of 604. And just to put that in context, that makes up 55.5% of our overall direct investment abroad. We've also produced our updated modified current account balance, or CA Star, for 2024. So we can see here the blue line is our current account balance, which you can see has some volatility due to IP imports and exports. And then the green line is our CA star figure, which you can see is much smoother. In 2022, our current account balance was 45.6 billion, while CA star is 14.2 billion. In 23, the current account balance was 36.9, while CA star was 6.2 billion. And in 24, we had a current account balance of 91 billion, with CA star at 25.1 billion. And just to say, the big change in the current account balance between 23 and 24 is largely driven by IP differences. So we had large imports in 23, which would pull down the current account balance, and large exports in 24, which had the opposite effect of pushing up the current account balance. We do have revisions to our CA star pretty much right across the time series. Even though BOP will only revise for 2 years, we use depreciation figures, which will have revised much further back from our national accounts colleagues. But we can see that the changes are quite small. So in 22, the revised figure is 14.2 billion, which is up just 0.3 billion on the previous figure, while in 23 it's 6.2, down 3.3 on the previous figure. And we can see here our CA star modified current account balance as a percentage of GDP. So this graph looks quite volatile, but the scale is quite small. So you can see it only goes from up to 4.5%. But just to put it in context with our overall current account balance, in 22, CA star was 2.7% of GDP, while the current account balance was 8.8%. In 23, it was 1.2% and 7%. And then in 24, CA star is 4.5% of GDP, and the current account balance was 16.2%. And looking at our adjustments, you can see over the years the much larger adjustments in years where we have large IP imports and exports. In 21 and 22 and 23, the adjustments were all a little over 30 billion. We've much larger adjustments in 24, which is due to the fact that the IP export is going in the same direction as a lot of the other adjustments, whereas when you have a large IP import, it tends to negate some of the other adjustments. But we can see that the change in CA star tracks the overall change in the current account balance. Something new this year, we're doing a bit more work on foreign controlled corporations, separating them out, giving you more detail. And with the large levels of multinational activity in Ireland, the impact of these foreign controlled corporations is significant. And one area of the impact is the net international investment position. So to help with this analysis, we've begun looking at our net IIP by ownership to show this impact. And we're using the ultimate controlling parent for ownership, which is the same thing that we would use for ultimate investor and FDI and for other FDI statistics. So we have two tables showing the net IIP by ownership. One is by reference sector, so showing your non-financial corporations, financial corporations and so on. And the other by functional category, which shows direct investment, portfolio investments and so on. So just to give a flavour of what's there, we can see here the blue line is our net international investment position. So this broadly shows the difference between foreign assets held in Ireland and foreign liabilities held in Ireland. And we can see that we have a very large net negative figure showing much higher foreign liabilities than assets. But when we remove the blue bar there, which is the foreign-owned corporations, it actually changes. So when you look at the green bar and look at just domestically owned corporations, we actually have more foreign assets held abroad than we do foreign liabilities. Just to give a little bit more detail on that, this is our net IIP by ownership just for non-financial corporations or NFCs and other financial intermediaries or OFIs. And these are the two sectors that are most strongly affected by M&Es. The non-financial certainly, but the other financial intermediaries would include treasuries and other parts of the M&E structures. So we can see here that the domestic NFC and the domestic OFI, the net figures are quite small. There is a strong positive for the foreign OFI, but you can see that far and away the largest negative impact is the foreign non-financial corporations, which would be largely driven by domestic assets like IP that are being balanced by foreign liabilities. As I say, we've been producing our US current accounts quarterly now, so these are just updated figures to include our revisions. So we can see that our merchandise balance has gone from 53.2 billion in 22 to 50 in 23 to 66 billion in 24, while our services balance has gone from minus 127 billion in 22 to minus 132 in 23, up to minus 156 in 24. And income outflows have gone from 90 billion in 22 to 62.6 billion in 23, up to 65 billion in 24. And these all combine to give us a current account balance in 24 of minus 154.9 billion euros. Something new we have done this time around is to show a net international investment position for the US. So this is purely foreign assets and foreign liabilities that are in the US. And we can see quite a large positive net effect here. And this is largely driven by portfolio investment assets that are related to investment funds. And at our seminar later, for everyone staying around, you'll hear a lot more detail about that. So just to give kind of a broad picture of our current account, we can see here this graph shows money flow from left to right. So on the left, we can see money flowing into Ireland from the UK, US, EMU countries, which are countries in the Eurozone, and other countries. And these would be the proceeds from exports of goods and services and income inflows. And then on the right, we can see money flowing out of Ireland again to the UK, US, those EMU countries and others. And this would be the funding of imports of goods and services and income outflows like the outflow of multinational profits. And the size of each piece gives the relative contribution. So I think it's important to see that we have really large gross inflows and outflows, and then the difference between the two, which you can see, it's not come through, sorry, is the difference between the two is that very small part at the bottom, which gives us our current account balance. So we can see that the inflows are fairly well geographically spread, while a big proportion of the outflows are going to the US. And this difference between inflows and outflows reflects the large negative current account balance with the US. Looking at merchandise, we can see on the left, again, this quite diverse spread of our exports going to quite a broad geographic base. Maybe less so in Q125 due to the larger exports to the US. While on the right, we can see the much lower level of imports. And the difference between these sides reflects the merchandise surplus. Looking at services, this looks much more balanced, but it's a little deceptive. So the left reflects exports of services. So for example, computer services. And again, we see this as quite geographically spread. While the right reflects imports of services, many of which support production not only of services, but also of goods. For example, royalty imports. And we can see the large level of imports from the US. And then looking at our income inflows and outflows, again, we see the low levels of income inflows on the left and the much larger level of income outflows on the right. And these are largely the outflows of profits generated by multinationals. And again, you can see the large levels of outflows to the US. So to summarise our annual data, we have a merchandise surplus going from 205 billion in 22 to 157 billion in 23 to 175 billion in 24. A services balance going from 9.7 billion in 22 to 18.6 billion in 23 to 59.7 billion in 24. Again, with that large difference in the services balance due to differences in IP between the years. Our net income outflows are 169 billion in 22, 138 billion in 23, and 144 billion in 24. And these all combine to give us a current account balance of 45.6 billion in 22, 36.9 billion in 23, and 91 billion in 24. With our CA star for the same years, 14.2 billion, 6.2 billion, and 25.1 billion. So this is our infographic, which gives a good summary of the results. And so you can see here our current account balance for Q125 of 5.8 billion euros, or 3.5% of GDP. So I'd like to pass back to Rachel to summarise.
Thanks, John. So to sum up, I'd like to highlight once again some of the key figures for 2024. We have GDP up 2.6% year on year, with our deglobalised indicator GNI star up 4.8%. Modified domestic demand is up 1.8%, with modified investment down just over 4%. Personal spending and wages are up nearly 3%. And finally, M&E dominated sectors have grown 1.5%, and the non-M&E dominated sectors have grown at over twice that rate at 3.6%. So once again, many thanks to Kieran and John for taking us through the results. And now we have an opportunity for the questions. So I'll remind people online to raise their hands or use the chat function. But I'll start with people in the room first, and if anyone online has an issue hearing the questions in the room, just let me know in the chat and I can repeat them. So, is there any questions in the room?